Thank you very much, and good morning, everybody. I do feel that my comments and presentations these days need to come with something of a timestamp on them, because things can change pretty quickly. When we kicked off this CEDA Roadshow a couple of weeks ago in Brisbane, well, back then iron ore was worth $40 a tonne. Today it's worth $60 a tonne, apparently. Back then oil was $28 a barrel. Well, now it'll cost you $38 for the same barrel. The Aussie dollar was sitting at 70 cents and going lower. Now it's nearing 75 cents and looks like it's moving higher. So it certainly highlights the old economist maxim, I suppose, about forecasting early and forecasting often. Certainly in the year, we did seem to be going down a depressingly familiar path where we were looking at global growth downgrades. Those downgrades are concerns about the outlook feeding into financial market volatility, and then back again in a negative way into financial market pricing and volatility. Now, I do have some charts to illustrate all these thoughts, but we've got a bit of a technical issue at the moment, but they'll be available on the CEDA website afterwards, I believe, so you'll just have to listen to me on this occasion. But what have we seen since the start of the year? Well, we've seen this very familiar process where the major forecasting agencies start talking about global growth running at around about 4%, something like its long-run average. And then as we get into the year, we start to see those forecasts revised lower as reality, if you like, catches up with the initial optimism. This year's been very much the same. We've already seen the forecasts for this year and for next year revised lower. We're probably going to see a little bit more of that coming through as well. And we certainly don't need any highlighting about the degree of volatility that we've seen in global financial markets so far this year. But when we think about the story, what's really going behind the scenes there, yes, for sure, global growth forecasts have been revised lower. But it hasn't been a wholesale downward revision. Most of what we've seen reflects country-specific factors. So as you'd expect, given the weakness in oil prices, prospects for oil-producing countries have been marked down. We've seen some countries like Brazil with particular problems that are in recession, and of course their forecasts have been lowered as well. But once we move beyond those specific examples, then most forecasts for other countries have been left unchanged. And from an Australian point of view, what's been particularly important, of course, is the critical forecasts for China haven't been revised in this latest set of downward revisions. Market volatility, well, as I say, that is a persistent theme, but equally, as we've seen over the last couple of weeks, just how quickly markets can change directions. The real risk here, of course, I think, is that volatility does feed back into growth uncertainty and concerns, feeds into business and consumer confidence, and then can have a real effect on economies. So we shouldn't ignore what's going on in markets, but we should put it into some sort of perspective. And when I speak to the traders and so on in our dealing room about why markets are so volatile, what are they reacting to? Well, the two sort of common themes that you hear is there's a level of concern there about rising US interest rates. How far and fast are they going to move on that front this year? And of course, you see a level of concern about what's been happening in Chinese financial markets and prospects for the Chinese economy as well. But we need to put some of this into perspective, I think. Now, it's certainly the case that US interest rates are now higher, but they're still pretty much at zero. So despite the rate rise that we've seen, US interest rates are still very close to zero. Even if we see 2 or 3 more rate rises this year, as we think, US interest rates will still be very close to zero. So it does appear to be an overreaction to a level of interest rates that are going to be low, whatever way you want to look at the data as we move through to 2016. Part of the issue, I think, is that it's actually been a very long time since interest rates went up anywhere, really. In fact, you've got to go back to 2006 in the US to find a rate rise cycle. And as somebody pointed out to me the other day, the last time the US did raise interest rates, the iPhone didn't exist, to put it into that sort of perspective. So it does mean that a lot of market participants now haven't really experienced rate rise cycles. So it's not surprising in some ways that they're viewed with some caution. if we turn the focus to China, I mean, certainly we've seen very big falls in share prices there, volatility in their markets that has spread through to the rest of the world as well. But again, if we put it into some perspective, there's been a lot of focus on the Chinese currency. It has moved lower, and those steps down that we have seen have created a lot of fear and uncertainty in markets. But from that perspective, if we look at the Chinese currency against the US dollar, for example, just to pick one financial market variable, well, the Chinese currency today is about 8% lower than it was at the end of 2014. So it's certainly moved down. Over the same period, the Aussie dollar's dropped by about 22%, and nobody really blinked an eye about that move. In fact, most people would see that lower currency as a positive in the economic story. I mean, there are some lessons I think we should take away from what's happening here, and that is that while we've known for a long time that what happens in China is very important for economic growth, increasingly we're going to have to watch what's happening in Chinese financial markets as a guide to what we might see happen around the rest of the world in the markets that we normally focus on. So that kind of synchronisation with China has become very important, certainly a risk factor that we need to think about and watch in all of our businesses. Likewise, I think what's happened over the last 12 months is this aura of invincibility that Chinese policymakers once had has taken a severe denting. Their problems in trying to control the stock market, what look like some missteps on the currency front, have raised concerns about their ability to step in and save the economy the way many people assume that they can, and certainly they have in the past. Well, adding to the fears we have seen has been the big move down in oil prices over the last 12 months, and certainly those forecasts of a $200 a barrel oil price of a few years do look to be a little bit off the mark. Clearly bad news for oil producers, as I mentioned earlier on. But what's been missing, really, I think, from the debate is the fact for many other countries, lower oil prices are actually a good thing. It does free up disposable income that consumers, for example, can use elsewhere. And when we think about this from an Australian perspective, well, most of our major trading partners are actually oil importers, and so that lower oil price is going to be a positive for their growth and then, in turn, their demand for our exports and so on. When we're thinking about interest rates, for sure, the Fed is lifting US interest rates, but other major central banks are still in the process of pushing their rates down and into negative territory in some cases, as we've seen in Europe and Japan as well. So the major central banks are moving in different directions. It's not just a US story when you're thinking about interest rates. And one of the other factors to bear in mind here is it's not just rate cuts that central banks are pursuing, they're also continuing with their quantitative easing policies. So they're still buying government bonds in an attempt to control longer term interest rates in their economies. And when I look at what the Japanese central bank, the European central bank say they're going to buy over the next couple of years, well, they're actually going to buy more government bonds than governments are going to issue through that period. So they're going to have to prize some of those bonds out of private investors, and it's demand and supply. That mix is going to give you something where bond prices rise, longer-term interest rates fall in that environment. So those sort of longer-term rates that are very important in some countries are probably going to be still moving in a way that's very supportive for economic growth more broadly. Now, while stock markets and interest rates are normally seen as the big threats to economic activity, they are very visible. The chance is this year that perhaps the bigger risk may in fact come from currency markets. And I say that because of what we're seeing happening with global trade. Now, economists have always promoted global trade as a good way to drive economic growth, to spread benefits around the world. But when we look at the data, global trade as a share of global economic activity actually peaked back in 2008. It's really just tracked sideways since then. Part of it's just a reflection of the slower global growth that we are seeing. But I think perhaps the bigger driver there is that long-run process where we were building global production chains, global value chains and the like, has pretty much been completed. Now, a lot of countries did very well by attaching their fortunes to the expansion and creation of those chains, particularly in the Asian part of the world that's most important to us. But if that process is complete, then countries that have relied on that as a growth strategy are going to have to look for something else. What it means, I think, is economic growth in a lot of countries will now depend more on what's happening within the country rather than what's happening outside a particular country. So, of course, the policy focus then shifts to, well, how do we protect that domestic growth? How do we contain it within our economy? And one of the ways you can is by having a lower exchange rate. So it's not surprising, really, that pretty much everybody wants a lower currency right now, but we can't all do it. Somebody has to be going up as others are going down. So I think the risk here is that we see an increase in trade restrictions, protectionist pressures, and maybe what happens in currency markets is where the real sort of global risk issue resides this year. Well, I guess from what I've said so far, it should be pretty clear, I think, that we see most of the risks facing the Australian economy as stemming from abroad. But there are some items of unfinished business in Australia that we should also keep a pretty close eye on. And they relate largely to the end of the commodities boom a few years ago. The outcomes there, and where the risks lie, of course, is that we've seen a huge slowdown in income growth in Australia as commodity prices have fallen. We're also seeing a huge rundown in mining construction activity as all those big iron ore mines and LNG plants run through to completion. Both of these things are big risks to growth. So on the income side, and we're seeing that income weakness everywhere, government revenues, household incomes, company profits and the like. I think in a sense we've sort of lost control of the income side of the growth equation. The focus in that case goes to costs. So governments want to cut spending as part of the budget repair process. That's a negative for growth. Companies are cautious about hiring new labour and capital spending, a negative for growth. And of course, if household incomes are weak, it just does limit their ability to spend. The mining construction downturn, or the mining capex cliff, as people like to call it, well, we're not particularly worried about that because we think we're going to largely export the problem. So, of course, as these big projects are completed, they are leaving us with something, and that is a big increase in resource exports. Equally, we've discovered that a lot of this mining investment actually went on imports. So as that spending dries up, so does the import flow tied in with that. And when I add up the decrease in mining investment, but the offsets from lower imports and higher exports, they pretty much cancel each other out. Now, there's a lot of job losses that are going with this mining construction downturn, and that's probably where the real risks lie. But we appear to be successfully exporting the problem there as well. Because what we are seeing is the really highly skilled construction workers on 457 visas and the like. Well, as those projects come to an end, they're moving on to wherever the next big project is around the world. So we're exporting them. It turns out a lot of these construction workers came from New Zealand, and they're going back to New Zealand. So we've exported the problem to them. And what has also helped is the fly-in, fly-out nature of the workforce. So people are losing their jobs in the Pilbara where they work, but they're becoming unemployed in Sydney or Melbourne where they actually live. So we're exporting the problem from the regions to the capital cities, and that's actually a good thing because that's where most of the job creation is occurring right now, and it's eased that part of the transition story. And you can see how this is playing out in the latest data. The GDP figures published last week show the Australian economy is running at 3%, despite this massive downturn in mining construction activity. We've had positive jobs growth all the way through this period of those job losses on the mining construction side. It does look like the unemployment rate has hit a peak at just over 6%. Well, it may be so far so good, but the question really is, can we keep it going? And to keep it going, we really do need to see this transition from the resources story to the non-mining economy succeed. And when I look at what are supposed to be the key drivers of that story, we are seeing a mixed picture. So the focus has been on residential construction, non-mining business investment, and government infrastructure spending. Well, There's no doubt there's a residential construction boom underway, so we can tick off that part of the story. Where the disappointment, though, comes through in non-mining business investment, which has really gone sideways over the last few years, and government infrastructure spending, which has actually gone backwards. In fact, government infrastructure spending today is about 25% lower than it was at the height of the mining boom back in 2012. So rather than adding to growth, it's been a significant drag. Will that change? Well, I think on the business capex side, we are seeing some encouraging signs there. One major stumbling block, though, is the very high rates of return that many businesses still put up there before any project will go ahead. And when the surveys tell you that most companies are looking at hurdle rates of 10 to 15%, well, that does look a little bit ambitious in the current sort of low inflation, low yield, low return environment. I think we do need to see some adjustments there. The infrastructure part of the story, well, we've already had obviously a very deep rundown on that today. We know what we need to be doing. We know what projects we should be pursuing. We just basically need to get on with it. And frankly, I don't mind if that involves borrowing money as well. When governments can borrow 10-year money at 2.6% today, you'd have to think there's any number of projects that are sitting there. They're going to deliver a much better rate of return than that. And again, we just need to get on with the job. I don't want to leave you with the idea that there's only sort of downside risks in the story. One of the sort of medium-term positives that I think we're yet to fully experience is the impact of the shifting centre of economic gravity. And that is, of course, that we're seeing that big shift in the central global economic focus from the US and Europe slowly and surely back towards Asia. So it's moving back in our direction after spending about 2,000 years actually moving away from us. People who've done the calculations here tell me that the global centre of economic gravity is moving at about 140 kilometres a year. So it's almost fast enough to see. But it does bring with it a lot of opportunities because the income flow that's dragging that centre of gravity back towards the Asian part of the world, well, the money there is going to be going down certain well-defined channels, some of it we can see already. So people typically want to spend more on food, more of it better quality as their incomes rise. They want access to education. Like everybody else, they like to go on holidays. They want to live in bigger apartments, and those bigger apartments are going to need more steel to hold them up. They also typically spend more on health and financial services. So there's plenty of opportunities there, I think, that we can all pursue if we have the wit to grab hold of them. And on that positive note, we'll finish up, and thank you for your time today.